A very good morning and wishing you a super Thursday ahead. Welcome to today's episode of Morning Wealth. Three things that we will touch upon. Big banks reported in the US, Grab's SPAC deal, and LVMH sales keep rising. Investors sold technology shares Wednesday, sapping momentum from major stock indexes as volatility continued to reverberate across the market. The Dow Jones Industrial Average opened higher, rising as much as 234 points and setting an intraday high after several banks kicked in the latest earnings report season with blowout profit reports. But the blue chip index gave up a significant chunk of the gain as the day wore on. Much of it evaporated after the release of a Federal Reserve report Wednesday saying that US economy accelerated to a modest pace and showed signs that businesses were raising prices between February and early April. Investors ramped up their selling of tech shares and shares of other high growth companies following the release of that report and undoing some of the group's recent gains and acting as a drag to the broader market. Investors have pulled back on the tech trade whenever signs have suggested the economy is strengthening and inflation is rising, which would eventually lead to higher interest rates. And as we have spoken earlier, higher interest rates dent the future earnings of tech and other companies and hence the price correction. The Dow ended up down 0.2%. The S&P also hit the highest ever level in the session and then slid, coming down by about 0.4%, and the Nasdaq declined further by about 1%. The Dow held on to gains largely thanks to bank earnings. Goldman Sachs Group accounted for a significant chunk of the blue chips advance, rising about 2.3% after the bank reported sharply higher profits for the first quarter, benefiting from a turbocharged market and an economic recovery. Goldman cashed in on another roaring quarter of traders and investment bankers amid the Reddit-fueled equities mania. Trading revenue jumped 47% and IB fees surged 73%. Shares rose, as did Wells Fargo's, after it offered an upbeat outlook for the net interest income and released more of its loan loss reserves than expected. So what is this loan loss reserve? After the coronavirus pandemic took hold in the US early last year, JP Morgan and other big banks actually set aside billions of dollars in loan loss reserves to prepare for a potential flood of consumer and business defaults. That rainy day funds ate into quarterly profits for much of 2020. But big losses never materialized and now banks are cashing in on their diligence. JP Morgan posted a nearly five-fold increase in quarterly profit thanks to booming markets and an economic recovery that allowed it to free up about $5.2 billion in funds that it had set aside. The largest bank in the US reported a quarterly profit of $14.3 billion or $4.5 a share, well above the 3.1 share which was forecast by analysts. The bank reported revenue of $32.27 billion, up 14% from a year earlier. Wall Street also powered JP Morgan's first quarter results. Corporate and investment bank profit nearly tripled to $5.74 billion, a quarterly record. Revenue rose 46% to $14.6 billion and trading revenue rose 25% from a year ago. Investment banking fees also rose 57%. While the outperformance was there, the share slipped, however, after Jamie Dimon said the loan demand is still challenged, though he later said he made a mistake using that word. Moving on, earlier this week, Grab Holdings said that it would be going public on the Nasdaq by merging with Altimeter Growth, a special purpose acquisition company, at a nearly $40 billion valuation. The deal will be more than double Grab's valuation in just 18 months. Shares of Altimeter had jumped about 10% earlier this week. That means another payday for SoftBank, which had invested in the company since 2019. Other backers include Uber Technologies, which sold its Southeast Asia business to Grab in 2018 and took a stake in the company, and China's Didi. Grab runs a super app in 8 countries in Southeast Asia, providing services including ride-hailing, food delivery, and online financial services. It is a market leader in ride-hailing with a 72% market share. It has half of the online food delivery in the region and around a quarter of the market in digital wallet payments last year. Its ride-hailing business took a beating due to COVID-19, but the pandemic has helped its deliveries business. The gross merchandise value of its delivery business nearly doubled last year. It's still not profitable though, but losses have shrunk on earnings before interest, tax, depreciation, and amortization. Certainly a big valuation win for Grab. We'll close out today's podcast with a bit of luxury. The world's biggest luxury company earlier this week said that sales increased by a remarkable 30% in the 3 months through March compared with the same period of 2020, stripping out the impact of exchange rate and portfolio changes. That isn't the effect of a pandemic sweeping across the world earlier last year. LVMH also said its first quarter sales were up 8% on a same apples for apples basis versus the same period of the pandemic-free 2019. The numbers, which easily beat analyst forecasts, lifted the Paris-listed stock 3% yesterday. The relatively modest reaction follows steep gains in recent months that have made the owner of Louis Vuitton and Christian Dior Europe's most valuable listed company, a position long occupied by Swiss food giant Nestlé. LVMH has been well managed during the crisis. It took advantage of strong demand for its good in Asia, where sales increased a whopping 86% in the first quarter. Businesses were run prudently as well. The business renegotiated rents in its stricken travel retail unit and spent on marketing when rivals were trimmed back, and all of that is showing on superior results. That's the update. Have a wonderful day ahead, and I'll speak to you tomorrow.